Hello and welcome. Over the next few minutes, I'll provide an update on the global financial markets and their impact on our strategies. I'll also provide some insights to what we expect for the remainder of the year. During the third quarter, investors experienced widespread declines across risk assets. Periods like these are unsettling. When they happen, following long stretches of relative calm, as we've had for the past few years, they can be particularly challenging. Fueled by historically low interest rates, U.S. equities have experienced one of the longest sustained stretches of positive performance in market history. Though it was from the depths of despair following the financial crisis, the market's 6-year run without a 20% decline makes it the third longest bull market U.S. equities have ever experienced. In fact, by August, we had gone more than 1,400 days without even a 10% correction. With equity markets steadily climbing, complacency naturally grew. Investors didn't need to be discriminating to do well. They simply needed to participate. Unfortunately, strong, consistently upward-moving stock markets do not last forever. Eventually, an unexpected catalyst of some sort upends the status quo and forces the repricing of assets. Such a phenomenon took place in the third quarter. A decline in the Chinese stock market was the first of a steady stream of shocks that prompted a fresh look at both risk and asset prices. Currency devaluations and a seemingly endless supply of negative economic reports out of China and other emerging markets all added fuel to the fire. Likewise, U.S. monetary policy also weighed on investors as the Federal Reserve continues to formulate plans to mitigate away from its most accommodative stance in history. An increase in rates, when it comes, will be the first in nearly a decade. In summary, the third quarter was a not-so-gentle reminder that risk is ever present. Gains are not guaranteed or easy, and the potential for portfolio losses has not been eradicated. Not by aggressive central banks and not through any particular form of investing, whether it be passive, active, yield-focused, smart beta, low volatility, tactical, or any other flavor of the month. When it comes to investing, there is no way to pursue gain without the potential for pain. The repricing of assets was notably evident in the commodities markets. With the apparent slowdown of key global economies such as China, the demand for core commodities declined, and the pricing of the aggregate commodity index dropped by almost 15% in the quarter. The energy sector was particularly hard hit, with oil, as measured by the average price of a barrel of West Texas Intermediate oil, down 17% year-to-date, and a whopping 59% since June of 2014. Stepping back to gain perspective, though it appears the expansion in the U.S. may be well established, it is our view that the global economic recovery continues to be a work in progress. So, a paradigm shift appears to be taking place within the equity markets that is creating a market backdrop more grounded in reality. A renewed appreciation for risk has led investors to demand greater returns for risks taken. That, in turn, leads to either smaller losses or greater gains down the road. Clearly a positive. As illustrated here, over time, investors have collectively priced assets to generate returns reflective of the risk trade-off. That's basic human nature and fundamental economics, and there's no reason to believe it will be any different in the future. So, what should investors do now, and what happens from here? Outside of changes in life circumstances or goals, deviation from a well-constructed plan is almost always emotionally driven and most often leads to horrible investment outcomes. Our investment portfolios are wisely designed to mitigate short-term risks while still being positioned for longer-term success. Longer-term success to help us help you achieve your financial goals and objectives. On behalf of the Private Client Group, thank you, as always, for your trust and confidence.